Hello, all of you. In today's class, we will learn one more topic, that is kinds of accounting principles. So, as far as the accounting principles are concerned, they are known to us by different terms, by different authors, such as assumptions, conventions, concepts, doctrines, postulates, etc. And these principles, they are classified mainly into two categories, that is accounting concepts or assumptions, and second is accounting conventions. Now see what is accounting concepts or assumption, and how many accounting concepts and assumptions are there, that also we will discuss one by one. So as far as accounting concepts and assumptions are there, in order to make accounting language convey same meaning to all the people and to make it more meaningful, most of the content have agreed on a number of concepts which are usually followed by preparing the financial statement. Now this accounting concept, they are what? They are the assumptions, and these assumptions are followed uniformly by all the accountant almost, so that the assumption will become more meaningful. For example, if you are walking on a road, what is the rule? Always left. When you are driving, always left. Now these are also assumption, means you have to walk on the left side of a road. And if all will follow the assumption, then only it will be a meaningful one. Because if some will follow always left, if some will follow always right, then what will happen? It will not be a meaningful one. The same in the case of accounting also. Many assumptions are there. So assumption regarding preparation and presentation of account will be meaningful only when most of the accountant will agreed on a number of concepts. So that's why this accounting concept, they are the assumptions which are followed by most of the accountant to make the accounting language convey same meaning to all the people and make it more meaningful. And these concepts, they just guide how transactions should be recorded and reported. Now see the various type of accounting concept. First is a business entity concept, which is also known as separate entity concept. So according to this concept, business is treated as a unit, separate and distinct from its owners, creditors, managers, and others. That means the owner of a business is always considered as a distinct and separate from the business he owns. And business unit have a completely separate set of books, and we have to record business transactions from the point of view of business, not from the point of view of the proprietor. That means all the transactions are recorded from the point of view of business in the books of business, not in the books of the proprietor. And because of this concept, the proprietor or the owner is treated as a creditor for the business to the extent of the capital invested by him in the business. So that's why you see in the accounting equation, what is accounting equation? Assets is equal to capital plus liabilities, where capital is also internal liabilities, because actual equation is capital is total assets is equal to total liabilities. Then total liabilities, it is divided into two parts, internal liabilities and external liabilities. And internal liabilities, it is termed as capital, and external liabilities, it is termed as liabilities only. So that means the capital which is invested by the owner in the firm, it is treated as a liability from the firm's point of view, because it is assumed that firm has borrowed fund from its own proprietor, and the amount which is withdrawn by the proprietor from the business for personal use, it is treated as his drawings, not expenses. So whenever the capital is invested, it is an internal liability. Whenever the proprietor is withdrawing something from the business for the personal use, it is treated as a drawing, decrease in capital or decrease in liability. So that is a business entity concept and a very important concept. Then second is a money measurement concept. So according to this concept, only those transactions and events are recorded in accounting which are capable of being expressed in the terms of money. That means only monetary transactions can be recorded in the books of accounts, because maybe an event it ought to be very important in business, but if it is a non-financial or non-monetary nature, it can't be recorded in the books of account. So that means only those transactions can be recorded in the books of account which can be measured in the terms of money. For example, if accounting it can't record strike, accounting can't record the efficiency of the managers, accounting can't record the honesty of the managers, accounting can't record the relationship between the employer and employee, because these all are non-monetary in nature. That means simply the facts are happening which cannot be expressed in money term or monetary term are not recorded in the books. That is a money measurement concept. Then next is a going concern concept. So as per this concept, it is assumed that, what is the assumption? That the business will run, the business will continue to exist for a long period in the future. That means the business will run for an indefinite period of time. It will run for a very long period of time, and that's why the transactions are recorded in the books of the business on the assumption that it is a continuing enterprise. That means it will run for a very long period of time, because what happens whenever anybody opens a business, the business is not open for a particular period. Whenever somebody opens any business, he always assumes that his or her business will run for an indefinite period of time. That's why nowadays all over the world many companies are there which are running from hundred of years, and still they are continuing with that. So that's why it is on this concept that we record fixed assets at their original cost, and depreciation is charged on these assets without reference to their market value. So because of this concept only, we used to record fixed assets at their original cost, because we are knowing that the business will run for an indefinite period of time, for a very long period of time. And if we keep on recording the market value of fixed assets, then for an indefinite period of time every day we have to change the value of the fixed assets, because someday it will be increasing, someday it will be decreasing. So how many times we will increase and decrease, because business is going to run for an infinite period of time. So we just record what, we deduct the depreciation, whatever amount of fixed assets is used or the value is declined, only that much is recorded. We ignore the market price of the assets, because it is impossible to daily update the market price of the assets if the business is going to run for an indefinite period of time or a long period of time. And it is because of the going concern concept that outside parties enters into a long term contact with the enterprise, because many parties are there who enters into a long term contact of maybe more than 1 year, 2 year, 5 years, 10 years, 20 years, 25 years. Just like see the case of NTPC and SECL. As long as the NTPC is here, the SECL is going to supply coal to NTPC. So that agreement may be for a lifetime. As long as the plant is here, coal will be supplied by SECL to NTPC. It is a long-term contract. And also, without this concept, classification of current and fixed assets and short term and long term liabilities cannot be made, and such classification would be difficult to justify. Now, regarding assets and liabilities, what we have learned regarding classification: fixed assets, that means which will be used for a period of more than 1 year, and short term means less than 1 year. And liabilities which will be payable within a year, and long term liabilities or non current liabilities which will be payable after 1 year. So how it is coming short term, long term, only because of the going concern concept, because business is going to run for a very long period of time. So on the basis of that time, we are making the classification. If an asset or liabilities they're meant for shorter period, it is a current assets or current liabilities. If they're meant for a longer duration, they become a non-current assets or non-current liabilities or long-term liabilities. The next is accounting period concept. So as the business is intended to continue indefinitely for a long period, the true result of the business operation can be ascertained only when the business is completely wound up. That means, as per the previous concept, what we have assumed, that business will run for an indefinite period of time. So that means the actual result of the business operation can be known only after the winding up, or what we call as a when the company will get closed. Then only the actual result, the profit, loss, actual value of assets, actual value of liabilities will be known. But thing is that a certain amount of profit after a very long period will be of little use to the proprietors, managers, investors, and others, because it will be too late to take corrective steps at that time, because okay, it will run for an indefinite period of time. But the proprietors, managers, investors, they can't wait for an indefinite period of time for the assignment of profit. Why? Because if they will wait for a very long period, maybe it will be too late to take corrective measures at that time. Because how will you able to know that business is running smoothly or not? What are the loopholes of the business? If loopholes are there, what corrective measures can be taken to improve the performance of the business? So that's why assignment of profit is very important, and the users of financial statement needs to know the result of business at frequent interval. So thus the entire life of the firm, it is divided into time period of small intervals, because what we have assumed in the going concern, that business will run for an indefinite period of time. So that indefinite period of time, it is divided into a time period of small intervals, and that small intervals time period is known as accounting period, which is usually of 12 months or 1 year. Okay, and according to the amended tax law, business has compulsory to adopt financial year beginning on 1st April and ending on 31st March in the next calendar year as its accounting period, because only on the basis of accounting period the tax liability of the persons are calculated, which begins from 1st April and will end on 31st March in the next calendar year. And one important thing is that apart from this, companies whose shares are listed on the stock exchange are required to publish quarterly result. After every 3 months, they have to publish the reports. That means in a year, they have to publish 4 reports. So partnership firms sold it only once in a year, but it is a compulsory for the companies which are listed in the stock exchange to publish their report quarterly, so that the shareholders, investors, they will have a glance of the performance of the company, and accordingly they can take decision whether to retain the share of the company or to sell it in the market. So few more concepts are there, so that we will discuss in the next class. Thank you.